Hey, good afternoon. Jeremiah Conjure here with Annuity Association, and we're excited to bring another exciting piece of content here for June 2022, which is Annuity Awareness Month. So, just a week or so ago, we put out a video on how to utilize a fixed indexed annuity appropriately to de risk a portfolio and provide protected growth. And we discussed things like sequence of returns risk and how to mitigate that using an annuity. And if you haven't watched that video, you can visit our channel here somewhere, wherever you're watching this video today, and find that video and use it as a good reference to understand how to use annuities for protected growth. Today's video, we're going to be discussing what we call the income expedition. This is all about using a fixed indexed annuity for contractual guaranteed lifetime income. And it's important to understand that when we approach the new phase of our life, the phase of retirement, which we refer to as the deaccumulation phase, it's when we're tasked with converting our assets that we've accumulated during our working careers into streams of income to support our lifestyle in retirement. Once you retire, and if you're not fortunate or blessed to have a pension, which less than 13% of private sector employees today have a pension, then you're being tasked with mitigating all of the financial risks that are associated with living a long life in retirement. Once that paycheck ceases and you're no longer earning income from your employment, we're now tasked with managing our assets that we've accumulated over time and designing them to create income streams in retirement. And while that may seem like a pretty simple task, actually there's a significant amount of difficulty and complexity that goes into that. You see, when you live a long retirement life and you're now being forced with deaccumulating your assets to generate income, when you live that long planning horizon, some people are going to live more than they've worked in their careers in retirement, meaning you might actually live in retirement 30 to 35 or more years, depending on your longevity and your health and things to that degree. But when you're faced with the long planning horizon, that's when we're faced with mitigating a ton of financial risks that are associated with living a long life. Things like, financial market risk, economic or socioeconomic risk, political risk, geopolitical risk, taxation risk, healthcare inflationary risk, general inflation risk. All of these things come into account, but one of the most significant and often misunderstood or under-discussed risks of retirement is what we call the sequential rates of return risk, or sequence of returns risk. And that is, how favorable are your market portfolio returns and what sequence of returns do those unfold? Without having a crystal ball, none of us know when we're approaching retirement if the markets are going to be favorable or not. And one of the most detrimental outcomes that can occur within the first 10-year period of retirement is if you have unfavorable sequential rates of return or negative rates of return within those first 10 years. So I'm sure there's a ton of people out there today that are approaching retirement, and given the current economic uncertainty that many are facing, there's a lot of worry or concern that, someone might lose what they've amassed to this point, or lose a portion of what they've amassed to this point in regards to their retirement nest egg. And their biggest fear is that they're either going to have two options. One is to retire with less money, or B, they might have to continue working a bit longer. But if we do the right planning and utilize the right tools and understand how all of those tools fit into the overall plan to mitigate all of those risks we just mentioned, then you can have a lot of peace of mind and confidence that your retirement won't be derailed and you won't be left with the option to either keep working longer or just simply retire and live on less. So without further ado, I'm going to go ahead and share my screen. We'll get into our handy disclaimer real quick, and then we'll dive right into this presentation. Thank you for joining us today. So again, we're talking about Annuity Awareness Month, which is for June of 2022. We're discussing fixed indexed annuities, and this is an independent review brought to you by AnnuityAssociation.com. By the way, if you are interested in working with our team directly, you can visit our website by going to www.annuityassociation.com. Right there on the main page, there's a red button to schedule your free annuity discovery session where we can get a further understanding of what's important to you and what your objectives are, and then help you understand the various annuities and annuity strategies available to address those needs. We're an independent annuity advisory company. We represent clients in all 50 states, and we'd be honored to have that opportunity to speak with you. This is a review, not a recommendation to buy or sell an annuity. No insurance company has endorsed this review in any way, nor do we receive any compensation for this review. This review is meant to be an independent review at the request of website visitors so they can see our perspective when breaking down the positives and negatives of this particular annuity. Before purchasing any investment product, be sure to do your own due diligence and consult a properly licensed professional should you have specific questions as they relate to your individual circumstances. All names, marks, and materials used for this review are property of the respective owners and not that of AnnuityAssociation.com. While care has been made to ensure this review is complete and accurate, no guarantees are made to the completeness or accuracy. So during this review, if you do have some questions and you'd really like an answer, just simply input it here in the comments section wherever you may be watching this video today, and I'll personally respond to you in a timely fashion to make sure that that question is addressed. We appreciate you tuning in. Plus, if you like what you see and hear and you feel like your friends or family could get some value, give us a thumbs up, like and share that video with them, and hopefully they can get some value out of this content today as well. Okay, so let's go ahead and share my screen again and get this document pulled up. So thanks to our friends over at Midland National Life Insurance Company, they put this document together for us, and it's all about the income expedition. There's an analogy used in financial planning, specifically retirement planning, of the analogy of hiking a mountain, that how it's similar to approaching retirement, or at least working and then approaching the retirement phase. And they use the Mount Everest as an example, that majority of the accidents that happen on Mount Everest are not on the way up, it's on the way down. And if you look at retirement planning is that deaccumulation phase. So you've already gotten up the mountain, you've already made the climb during your working career and accumulated a nice nest egg to retire on and use as income to support your lifestyle. Well, the majority of accidents in retirement planning occur on the way down during that deaccumulation phase because of poor choices or poor planning or lack thereof. So that has to do with the picture here. So if you're ever wondering why these insurance companies and other financial institutions like to use hiking, that is the reason for that. So imagine you decided to climb a mountain. How would you prepare? Likely you would be very focused on the strategies for a successful climb and the materials you would need, and maybe how to take that amazing panoramic photo at the top. But how much thought did you put into preparing for the way back down? The road to retirement is a similar adventure. Many consumers are focused on accumulating money for retirement, but may not have planned for the deaccumulation phase of retirement. Have you put as much planning into the descent as you did on the ascent? If you feel like you need to prepare more for the climb down, you're not alone. This is a great time to start your income expedition. So what are the risks on your journey? Setbacks in life are almost inevitable, ranging from job loss and market recessions to health events and major unexpected expenses. While working through the accumulation phase of retirement planning, you can typically adapt to these roadblocks and setbacks with time. On the way down the mountain, however, it can be more difficult to overcome some of the risks you may face. Let's take a look at two of the most common risks you may encounter on your income expedition. And so one of these is the market volatility risk, the drawdown dilemma. Ensuring your retirement assets still have growth potential is a smart choice, as inflation and other factors can erode the purchasing power of your money. However, if all of your aspects are subject to market volatility, you can run into the drawdown dilemma. In this scenario, you can run out of money sooner than anticipated simply based on the timing of when you begin withdrawing retirement income. And then there's longevity risk, and that is the potential to outlive your money. It's no secret people are living longer, which means retirement is often longer too. Regardless of whether your retirement assets have a high, medium, or low growth potential, can you guarantee that you won't outlive your money? So let's discuss the drawdown dilemma. Could a sequence of returns deplete your savings? So when it comes to generating sustainable retirement income, many people only think of an average rate of return needed on their assets. However, what might be more important is not the average return, but the order of those returns. Let's take a look at two different hypothetical scenarios in which one begins taking withdrawals in 1998 and another that begins taking withdrawals just 2 years later in 2000. Both have $500,000 at the time they begin withdrawals, and 21 years later, with just a difference of 2 years from when withdrawals started, one scenario still has over $100,000, while the other's account is depleted by year 15. So this is going to be a good deep dive example of that sequence of returns risk, which everyone faces as they enter the phase of retirement. So here is a nice chart, and if you haven't done so already, you can enlarge your screen by clicking on the bottom right-hand corner of your viewing window. There should be a little icon or box there. When you click that, it will enlarge it and hopefully make this large enough for you to see today. So here we have two lines. We have the scenario A, which is when withdrawals begin in 1998, and that's marked as the dark blue line on the chart. And then we have scenario B, which the withdrawals began 2 years later in year 2000. You'll see this chart is starting from 1998 going out to 2021, and it's showing the beginning account values on the far left. Both of those started with $500,000, which you can see indicated right here, where I'm highlighting with my mouse. And then you can look at the trajectory of those account values once income had started, which is in the beginning of the line. And you can see the results and how they differ just by having slightly varying sequences of returns. 1998 had more favorable returns in the beginning years of retirement, indicated by this chart line going up on the graph. So even after income turned on, in years 99, 2000, and maybe some into 2001, they had positive returns. And then as you remember, the dot-com bust happened in the early 2000s, 01, 02, and 03, 3 consecutive years of negative market returns. And you can see that because of the blue line, the person that started in 1998 in scenario A, because they were able to maximize or at least benefit, not that they had a crystal ball to even know, but because they retired in 98 and were able to get 2 more years of positive growth on their portfolio, it had an incredible lasting impact in a positive way of the success of the outcomes at the end of the journey, at the end of their retirement. Whereas scenario B, unfortunately, not knowing again that the markets would go down because nobody had a crystal ball, but they retired on the peak. And there's a lot of people today that are really starting to believe that we're at the peak right now and starting to slope downward into a similar market economic decline. And if you noticed how large that peak has climbed over the last, 13 years or so with this bull run that we've had and all of this money that's been printed over the last couple years from the COVID pandemic crisis. With $7 trillion being pumped into our economy, that peak is, it's astronomically higher than the previous peak we had back in 2007. So anyways, scenario B retired on the peak. And unfortunately, they were met with 3 straight years, or at least two for sure, but looks like 3 years of negative returns in the beginning of their retirement, all while starting to draw an income off of that portfolio. And so when you start to withdraw income from a portfolio that is invested in the stock market, and that portfolio is not only going down due to negative market performance, but we're also eroding it from income withdrawals, it has a compounding effect. So we're selling more shares at a lower price to give us or supply us income that actually has a compounding effect on the losses. And so as you can see in this example, scenario B's account was depleted by 2013 simply due to a different sequence of returns. What also would be very interesting to note is how the average rate of return compared to one another, and maybe they'll provide that in this example. Let's take a look. So as we come down to this chart here, we're going to notice the specific itemized annualized rates of return on the portfolio. You'll see scenario A starting in 1998. It had those two positive years. In 98, it gained 26.67%, and in 99, 19.53%, lifting their $500,000 account value to $675,731 at the end of 99. And then they were met with those three unfavorable years, 2000, 2001, and 2002, with those negative returns. And then you'll notice across the way here in scenario B, because they happened to retire during that peak of 99 and 2000, and then they were met with those 3 consecutive years of negative returns, look at the impact of the portfolio. 238,465 versus 343,697. And then what happens is, because of those negative returns impacting scenario B's portfolio and bottom line during those first few years, and they're taking an income withdrawal from that portfolio, we can see that they went broke by 2013. So we'll see the zeros here indicated by 2013. Whereas in 2013 for scenario A, they still had $203,939. If we come all the way out and now look at, 20 plus years of returns, there's still 52,000 at the end of 2021 versus zero. I mean, this account's been broke for 8 years. So this is a very, prime example of the impact that sequence returns can have on someone's success or the outcomes of someone's retirement plan. I'm not trying to scare anybody here. This is not a scare tactic. We don't operate in that manner whatsoever. But this is factual data that we all need to be aware of, because at the end of the day, regardless if you manage your accounts or you have a financial advisor or you have a broker or somebody that manages your money, nobody, including myself, have a crystal ball. But in retirement, you only have one chance of getting the plan right. So why take the risk associated with sequence of returns and not mitigate it? It's just inexcusable. We need to plan for the worst rather than always be hoping and praying for the best. And if you can mitigate those potential what if scenarios, even though they might be rare, think about the peace of mind that's afforded, knowing that regardless of what the outcomes are in the next handful of years when you retire, that your retirement is not at the dictation of the markets. It's not being dictated by unfavorable or favorable returns. We have a plan to mitigate the worst case scenario, and that's going to give you a lot of peace of mind that regardless, you're going to be able to get to and through it. So next is the longevity risk of outliving your money. Consumers who hope to avoid market volatility might be tempted to put their retirement assets in a vehicle with little risk of loss, but also little growth, possibly missing out on any upside potential. In our hypothetical example, a person retires at age 65 with $500,000, and their money continues to grow at 3%, and they withdraw an annual income of $30,000. Even with a sturdy starting balance of $500,000, this person's assets runs out by age 87. If they live until age 95, they will go almost 8 years without a retirement paycheck. And so here the assumptions are the initial beginning value of the portfolio of $500,000 with a 3% conservative annual growth rate, $30,000 annual withdrawal. So they're just showing us if we were to use a more conservative investment for the retirement assets, maybe only achieving a 3% annual growth rate while taking a $30,000 annual distribution, what this might look like. So you'll see the $500,000 starting here, and then starting at age 65, taking that $30,000 annual withdrawal, we'll see how it unfolds. And the question becomes, will you or your spouse outlive your retirement paycheck? And just at a 3% conservative growth rate, providing a $30,000 income withdrawal, obviously that growth rate in that conservative vehicle is not efficient enough or sufficient enough to provide enough return to keep up with the withdrawals that are coming out. And this account does deplete by year 23, the end of year 23. So let's talk about income needs review. How can we determine how much income we need and how much we should build into our retirement strategy? So a critical step in building a retirement strategy is an assessment of your anticipated expenses and income. The following exercise will give us an idea of potential gaps you may have. This list reflects common expenses, your needs and wants that you may encounter during retirement. So obviously you're going to put all of your essentials, your monthly expenses that are required to live your lifestyle and support it for the long haul. So your, housing expenses, your living expenses like groceries, clothing, your auto payments and insurance, any additional expenses like gas and car registration, things to that degree, and any travel budgets. We also want to consider your healthcare expenses and your general living expenses, including going out to dinner, things like that. So your lifestyle needs as well. And then we want to see what current sources that are predictable do you have to count on now? Things like pensions, if you're blessed to have one, Social Security, and other guaranteed income from things like income annuities. And you'll add all of those up. And then once you've added all of those income sources up, then you're going to take a simple formula of your total monthly expenses minus your estimated monthly income. And this is what we call your income gap, the difference between those two. If you have a deficit where your expenses still exceed your income sources, and when we say income sources, we're specifically referring to guaranteed income sources. Guaranteed income sources, things like pensions, which are guaranteed contractually, things like Social Security, which, that argument could be had, but it is considered a guaranteed source of income. And then the other would be a contract between you and an insurance company through an income annuity. That also is considered a guaranteed source of income. There's only 3. Real estate's not guaranteed. Your tenants can move out. Your house could burn down. Income is not guaranteed from rental real estate. Same thing with stocks that are paying dividends. Same thing with bonds. All of those things are not considered guaranteed sources of income. Once you've added those up, subtract it from your expenses. And if there's a deficit, meaning money that's not covered by those 3 guaranteed sources, then you've identified what your monthly retirement income gap is. And the philosophy here, and this is something that all of the PhD experts in retirement planning, all of the economists that specialize in mitigating retirement risks, 100% unanimously agree that when introducing an income annuity to address that income gap, the deficit of your expenses that are left over after all of your guaranteed sources of income have been added, they all agree that having an income annuity to meet that gap and fill it is a superior and optimal way to mitigate not only sequence of returns risks, but all of the other financial risks that we face, including the longevity risk. Because an income annuity, when all of your expenses are covered by guaranteed sources, you create an optimization by taking the pressure off of the rest of your estate's assets. All of the rest of your assets that are left in your investment portfolio, since that independency has been created from that portfolio in the sense that it's not required to be an income source any longer, one can now afford to take more risk on that investment portfolio if they so choose, and optimize the returns on the remaining portion of assets, because you're now going to have the wherewithal to ride out the volatility of the markets and not have to play the timing game, timing when to get out and when to get in. You can now withstand that market wave of volatility and not be forced to sell out of your positions in fear that your income source is going to be depleted. So when you're able to do that and create an optimization using the right tools to address your essentials, your essential expenses, now you can ride out that wave. Now you can let your money stay in the market, and now you can take advantage of when those markets do perform well, and when they will perform well is over a long period of time. The key is being able to sustain it and leave it in there to allow it to grow. Over long periods of time, the markets go up. But if you're being forced to sell in down years and continue to sell more positions to generate income, that's not an optimal scenario, both from an economic perspective as well as the psychonomic or the peace of mind perspective. So it's one thing that we're very passionate about, is helping people understand these concepts and how to, add them as a strategy to their overall retirement portfolio and ensure that their retirement is not derailed due to unforeseen events. So again, it's about the income expedition, that deaccumulation phase of your retirement. It's about the way down on the mountain and how to prepare for the descent. Now that you've determined what your guaranteed income needs might be, you may be wondering what's next. And we understand retirement planning can feel overwhelming. So we have two options to help you on the right path. These are some options that Midland has put together. They have the Midland IncomeExpedition.com or MNL IncomeExpedition.com, as well as the Midland National Income Planning Annuity Calculator, or better yet, if you'd like to chat with a financial professional, someone that has your best interest at heart and that really understands how to utilize annuities appropriately in retirement, and that's going to give you a full educational and transparent process to help you make an informed decision on A, are annuities right for your situation, and B, if so, which one is going to be the best for your circumstances. We'd be honored to have the opportunity to work with you. You can work with our team. We're licensed in all 50 states. You can visit our website at annuityassociation.com. Right there on the main page, there's a red button. You can click to schedule your free virtual annuity discovery session, where we'll really get an understanding of who you are and what's important to you, give you an understanding of who we are and what our mission is. And if we're a right fit, we'll help you, make an educated and informed decision on which annuity is right for your situation. We appreciate you tuning in. This was a pretty short video for us today. We thank our friends over at Midland National, a Sammons financial company, for putting this great piece of content together. And if you have any questions, again, feel free to post them right here on whatever platform you're using to watch this video today. If you liked it, got some value out of it, give us a thumbs up. We'd appreciate that. And we look forward to hearing some positive feedback from you out there. And again, thank you for watching. So Jeremiah Conger with Annuity Association signing off. Take care of one another. Have a great day. Thank you.